going to start off with a summary of what we kind of saw happening this week. And so first off, let's look at the stock market for the time frame from the very high back at the beginning of 2022. You can see there all the way till today. And so really amazing time frame. Obviously had a big downturn, lots of running upward, down motion in the end. And this year has been fantastic altogether in comparison to last year. And today we're sitting at the high for the year. And it's been a couple weeks since we had our last show. And what we talked about at the last show has played out almost perfectly here over this 2-week period, because we talked about how, we'd had that big run up and it was Friday, kind of triple witching Friday, with the options expiration. And then we have the end of the quarter, which is when all these big funds tend to rebalance, right? And so if you're a big target date fund that's supposed to have 60% in stock and the stock market does great and it gets to 65, at the end of the quarter, you might be selling that extra 5% and buying something else. And if you watch closely, we exactly had that happen. The bond market was kind of doing okay during that time. And I think, again, the stock market was coming down. And if you looked really closely, even within the stock market, those things that went up the most got hit harder because, again, if it's tech stocks, which had a really big run, they would get hit even harder. And then we finally hit that low point. And during the daily videos, I was talking about maybe the 28th, we would hit that low because that's pretty similar to what happened in previous quarters. And we actually hit that low the 26th and started to take off. Now, we have signals that we use for the stock and bond market. So our stock market signals right now are both green. But we did get on the fast signal a yellow signal during that downturn. And so one of the things that you have to think about is kind of, what's going on. And it's kind of funny. I listen to CNBC and Bloomberg radio, just like everybody else. And during this period of time, I kept talking about the rebalancing, and that once it's over, it could shoot back up and get back to a new high and all these things. But when you're listening to the news during that downturn, the news tends to attach things to a downturn. Yep. So they're losing confidence in tech stocks. Well, apparently not, because they're really flying today, right? So, or whatever it is, they try to do that. And they're not always looking, in my opinion, at kind of the supply and demand issues. If you've got these very large institutions rebalancing, it's a temporary scenario and what have you too. So that's something I think is really important for what has been happening here over the last couple of weeks. And now we're going into this new high. We have talked, quite a bit about, the reversal of trend, going from that kind of blue line there that's showing that downtrend to now we're seeing this reversal. And kind of the checkbox things that I've had and looking for, and all of those were achieved. We got past the debt ceiling, right? Yep. We've got consumer confidence came out today. It was really high. Yeah. And so the consumer continues to drive this. And we're supposed to be having a terrible stock market first half of this year. If you looked at the articles from the second half of last year, we were supposed to have bad earnings, creating this big downturn, be down maybe 20, 30% from where we are now, right? Couldn't be farther from being inaccurate, right? And so what's happening here is that under traditional measures of finance, when you raise interest rates 5+%, like the Federal Reserve did in essentially a year, you're going to have a hard landing. You're going to have a big recession. You're going to have a situation where the stock market does come down pretty heavily.
Yeah, and you can see, even though the Fed has raised interest rates up to 5%, unemployment is still low.
Yep.
GDP is still growing.
Yep.
So there's a great possibility of a soft landing that they've been shooting for.
Yeah, I mean, we're essentially having the soft landing right now as it goes. I mean, the middle ground is where we're at and where we've been for quite a while. Things can change.
Yeah.
And we'll talk about how we would respond to those changes. But you're exactly right. This week, gross domestic product was revised up to 2% growth. On an annualized basis, it was supposed to be at 1.4.
Yeah.
Not bad. Unemployment, first-time unemployment claims, which come out every week, we're at 239,000. The expectation was 270,000. So Unemployment claims are doing well. There's a lot of job openings. Unemployment as a number is doing fantastic. It's very low. Now, always keep in mind, though, because this is one thing that kind of trips people up, is that employment and the job market tends to be a lagging indicator, right? When you look at the leading indicator grouping, LEI, there's 10 indicators in there. Housing starts, that's a leading indicator. So when somebody's applying to build homes, that's a good thing. The S&P 500 is in that grouping. You will not see the employment issue. Actually use an inverse portion of the employment, but nonetheless, things are pretty strong. Consumer continues to drive, and so the reason I think that we're not having this big downturn is because we have this pandemic, which is driving spending, and the motion is moving from goods to services, and that's still going. And obviously, what we're doing is fighting with inflation, and we'll talk about that in a minute too. But that's a really good chart.
Yeah.
I mean, it really is. Things are doing fantastic. I've been saying for a while that, we're now in a bull market officially. We get more than 20% up from some low, which we did here, about 6 weeks ago, I guess. And again, shortest bull market's 2 years. We're 8.5 months into this. Average bull market's 5 years. So because there's still tons of articles talking about how the market's going to fall now in the second half of this year, or maybe the first half of next year. Again, they could be right, and we'll be ready. However, that would be a new record, right? I mean, to fall another 20% from here would then put us into a bear market, shorten this bull market to the shortest ever in history, in the middle of all of this spending going on from, these consumers and this pent up demand. So, it's possible. It just seems a little less likely, especially now with the way things are going. So I'll show you just some example here. Let me change views so we can see this a little bit better. This is our 100% traditional model. We have an ESG model, a green model, and traditional model. Traditional is our biggest. And this is our all stock. We don't have a lot of people in this because it's kind of aggressive, but just to kind of show you how the process works, and maybe this will help you. So we have 174 ETFs currently in our universe that we look at, and they're segmented. We got bonds, and we got stocks, and we have core, which are kind of the big diversified pieces that we might put more money in, and we have kind of target, right? And that's maybe more narrow and more aggressive or what have you. So right now you can see that the two big pieces here are both ESG core pieces. Now, this is not an ESG portfolio, so we don't have any real reason to put them in there. It's just that what we do is they compete. And so I look at this like a soccer team, and you've got different players on a soccer team, and they do different things, and that's their specialty, right? And then you got a bunch of people on the bench in each one of those positions. And so they're all competing to get on the field. And so the ESG core pieces have gotten on the field because they're outperforming the other parts. And mainly is because technology has been doing so well. And lots of times when you put an ESG screen on something, you end up with a lot more technology because they tend to make it through those screens. So we have those two pieces, but we also have cybersecurity, our robotics and artificial intelligence. We have an overall tech index, XLK, which is the S&P's 500 spider, tech shares. We have cloud computing, QQQ, which is the top 100 stocks on the NASDAQ in size, and semiconductor stocks.
Yeah, you can see how it's a very heavy overweight to tech and like mega cap tech, I would say.
That's exactly right. And so one of the ways that you can really tell what's going on is to look at this universe and look at what's going. So if things start to do poorly, right, and the markets start to fall apart, and these people are right, and we do have this big downturn the second half of this year, the beginning of next year, what will move up will be the more conservative things, your healthcare, your utilities, your treasury, T-bill type things,
your
right?
value stocks,
Value stocks, they'll move up that list, and these things will go back onto the bench, and the playing field will be populated by other players that are performing better at that point in time. And so that's how we do it. We have kind of a rotation that comes out of this universe. The creation of that universe is really important in terms of how you pick what's in there, how many of each thing you have in there, those types of things. And then basically you have this rotation. So it's really, it's kind of self-fulfilling. But I'm telling you, one of the things that helps us a lot is just seeing that universe and seeing what's moving, what's percolating up to the top of the universe. And you can really tell kind of from a broad basis what's happening. And obviously you can see here that artificial intelligence and technology. I said this before, but during the debt ceiling argument, the 7 stocks on the S&P 500 were really running.
Yeah.
And I thought it was because of it's sort of a safe haven, right? And our hope was, and we talked about this, was that there'd be some spread of that money eventually once the debt ceiling was done. And that's actually happening. We're seeing some motion in other areas besides just those big tech names, although they're still doing well. Yeah, so they kind of got a momentum going and people are buying. And, so obviously there's a lot of different drivers that are going on in the market, but things are going pretty well right now. Okay, so let's look at this. This just came out today.
Yep, this morning.
PCE stands for Personal Consumption Expenditure Index. All right, it's a mouthful. But just know that when we talk about inflation, we're normally talking about CPI, Consumer Price Index, right? And that's the one everybody kind of knows about. It comes out middle of the month for the month prior. This is June 30th. This is for last month, for May. So it's always late. Nobody really talks about it. The reason to know it is because this is what the Federal Reserve looks at. They don't really look at CPI as much as they do PCE, and this is their key thing. So, and there's 2 pieces of PCE as well as CPI, and that is top line, which just means includes everything, and then core. So if you look at this, really nice pattern.
Yeah.
Right? Coming down nicely. This is including everything, 3.85%. All right? And so that's not bad. Now, the Federal Reserve is trying to get back down to 2%, but it's not on this one. It's on core. So in core PCE, we take out food and energy. And the reason they take out food and energy, because the Federal Reserve says that they feel like they don't have as much control over those 2 categories with their interest rate increases. And they really, they're more volatile aspects anyway. Sometimes they can give some false signals. And so if you look at core, though, it's a lot stickier. Yeah. And it's at 4.62%. That's what they're trying to get to 2%. So here's the thing that I would be watching, because so many of the articles are talking about recession, right? Recession, based on the interest rate increases that have already happened. I would probably refocus on inflation, because if you look at this core is hanging in there, and the market is now flying. We're up, 25% off of that low back in October. People are starting to feel wealthy. Consumer confidence just hit a really high number, right?
Yeah.
People are getting out there. That's inflationary. And I think that's probably what I wouldn't be surprised to see this come back up at some point in time. And what that's going to do is create some issues for the stock market in the sense that the Federal Reserve, they're already talking about doing 2 rate increases, and Jay Powell had several testimonies here over the last couple of weeks where he really stuck to the guns. 2 increases, most likely next 2 meetings, which would be July and September. And they're really talking about quarter point increases. So, it wasn't that long ago. It was last summer they were going 3/4 point, which is a big one. So nonetheless, I think that's going to be more of the focus here. Is that that things are still too strong. The job market is still too strong. The consumer appetite for spending is still too high, and we might see some motion upward here. With one caveat: the one way we can keep going, keep a soft landing in place, keep the Federal Reserve to 2 increases instead of more, is by an increase of supply, right? And so if we go back here, so the overall inflationary environment, including food and energy, is coming down nicely.
Yeah.
So that means food and energy is coming down. The demand for food and energy is not coming down, right? Matter of fact, the demand for energy continues to go up as the world reopens, as China reopens. But what's happening is the supply is higher. It's coming online. So we're getting energy coming in, we're getting food coming in, and that's now still getting more expensive. You can see it's still 3.85%.
Yeah.
There's still some growth there. It's not like it's getting cheaper per se. It's just not growing as quickly. Yeah. And because there's inflation and then there's deflation, right? Which is where the prices go down.
Yep.
And that can happen. You were talking about eggs, right? It went up, way up, and they came back down. And then there's disinflation, which is the one in between where things come go up slower. So we're having disinflation in energy and food, and that's because supply is coming in. So when we get back to core, if we want to avoid, lots of rate increases, the one way that can happen is if we see more supply coming in. Now, this is very heavily oriented around services.
Yeah.
For PCE. Services take labor. And so when you see the job numbers, how many jobs were created for the month before, they've been very high.
Mm-hmm.
That's excellent, because that's what needs to happen.
Yeah.
We need to get more and more people back to jobs in these places where the demand is.
Yeah, and like labor force participation is like what, a 15-year low, and it's coming back, but
Right.
after the pandemic, it hit such a low.
Oh, that's for sure, and it's still coming back, and coming back nicely. So anyway, that's the overall kind of take-home message. I think this is a very, very fascinating time frame. Things are doing well at this time and place. We should celebrate that, have a chance to continue to do well and continue to have a stock market growth with inflation continuing to at least stay where it is or come down. I think that has a lot to do with supply. Demand is growing here. I can feel it. You can tell what's happening, and people are not afraid of the stock market. There is still probably a tremendous amount of money on the sidelines, right? And because at the end of the year, Bank of America had a big study survey of the big money managers, pensions, and what have you. They were at a 70-year low in terms of their exposure to the stock market. And so that money is going to come back in. It's one of the reasons why, if you look at that chart, we're getting a pretty steep increase here.
Yeah.
And that's because there's short covering that happens. And then there's this money that's coming in off the sidelines, because if you're one of these big money managers who's been saying the market's going to fall, and you're sitting on the sidelines, you're getting crushed.
Mm-hmm.
I mean, if you're being compared to the S&P 500 or whatever index it is, you're being crushed, and eventually that pain just becomes too much and they start jumping in, and then of course it goes up further and then more people are jumping in, and that's how these bigger runs happen. And again, if you look back, I always bring this up, but back in 1982 when they finally got inflation under control, it was 106% gain that year on the S&P 500, and I'm not saying we're going to do that here either, but it just shows you the power of that money that's sitting on the sidelines all coming back in, and then everybody's kind of rushing back in because you're competing. We compete with these indexes all the time, and it's not easy because they're always in.
Yeah, and there's a similar thing happening with high net worth people. They were saying that compared to 2022, they had 10% more in cash, like cash equivalents, than they did the year before.
Yeah, and rightfully so. It was a pretty bad year last year, right? I mean, you look at where did you go? I mean, the bond market, the 10-year Treasury market in 2022 had its worst year since 1783. That's pretty bad. So you don't want to be there. That's where the banks were, and that's why we had trouble with some of the regional banks. They like those type of little longer-term treasuries. It's kind of how it works. So yeah, exactly. But now things are starting to improve. Bond market is still, let's show the bond market signal. Actually, forgot about that one. And so there we've got, still have a yellow on the slow signal and green here on the fast signal. So nonetheless, picking up, we're almost all green. So we'll see how it goes here. All right, so that's our summary for the week. I really appreciate everybody kind of sitting through that. I look forward to being able to talk about that again next week.